Silver has been treated as a secondary market, useful, volatile, but ultimately subordinate to gold and equities. And that assumption is being quietly tested today in ways most participants didn't anticipate. What unfolded wasn't just price movement, it was a shift in behavior across futures, physical, and derivative markets that rarely align, and the alignment itself is what's raising eyebrows. Early signals appeared before the broader market noticed, when price began moving without the usual catalysts attached. No major macro headline, no obvious currency shock, no central bank communication to lean on, yet bids kept appearing, not aggressively, but persistently, the kind of demand that doesn't announce itself and doesn't retreat easily, hinting at motivations that sit outside daily trading narratives. As volatility expanded, the usual intraday relationships started to weaken. Silver moved independently of gold for stretches, decoupled from the dollar at moments when correlation models would normally reassert control. That kind of divergence doesn't happen by accident, and it tends to surface only when positioning beneath the surface has already changed. Liquidity told its own story. Depth thinned faster than expected during routine hours, spreads widened briefly, then normalized without follow-through selling. That pattern suggests not panic but selective participation. Fewer sellers willing to lean into size, and buyers content to wait, absorbing supply quietly, which raises questions about who was absent rather than who was active. Derivatives markets added another layer. Options pricing began to imply uncertainty in direction, but confidence in magnitude, a combination that's uncomfortable for market makers and often precedes structural repricing. Skew shifted without the dramatic volume spikes typically seen during speculative bursts, implying adjustment, buy desks managing risk rather than chasing momentum. Physical indicators, while slower, didn't contradict the message. Premium behavior in certain regions stopped tracking futures as tightly as usual, not exploding, but refusing to compress when price paused. That resistance hints at underlying demand that isn't sensitive to short-term pullbacks, a trait more common during regime changes than during rallies. Institutional behavior remained outwardly calm. No urgent commentary, no visible repositioning disclosures, no abrupt policy reactions. Yet, silence at that level often signals internal reassessment rather than confidence, especially when models built on historical volatility start producing outputs that don't match observed flows. What made today different wasn't the size of the move, but the absence of reflexive correction. Markets accustomed to disciplining silver quickly found fewer participants willing to enforce those boundaries. When a market stops responding to its own history, it forces every participant to reconsider what assumptions still hold. By the close, price alone told an incomplete story. The real shift was psychological. Traders watching levels that used to matter lose influence, risk managers recalculating exposure ranges, and long-term holders noticing that the usual signals to disengage never arrived, leaving an uneasy sense that something fundamental may be reorganizing beneath the surface. This is the point where silver has historically either retraced quietly or accelerated into instability, and the difference is usually determined not by headlines but by who steps in next and who doesn't. Historically, when silver enters this kind of unsettled phase, the next signals don't come from price charts, but from how institutions adjust their tolerance for imbalance, and today those tolerances were quietly tested. What stood out wasn't aggressive repositioning, but hesitation, a subtle reluctance to press against the move that suggested existing frameworks were being questioned rather than defended. Throughout the session, Order F, when those windows approach during unstable conditions, even small positioning mismatches can produce outsized reactions, not through intent, but through necessity. Physical market flexibility also came under scrutiny. Refining capacity, transportation, and regional distribution don't respond instantly, and delays in any one segment can amplify stress elsewhere. Today's price behavior suggested confidence in near-term availability was being quietly reassessed, even if no shortage was evident. Risk transfer showed signs of friction. Participants seeking to offload exposure found counterparties more selective, not absent, but cautious. That selectivity matters because it raises the cost of adjustment, increasing the likelihood that positions remain in place longer than planned. What complicated matters was the absence of a shared timeline. Some participants appeared positioned for weeks, others for months, and those horizons don't coexist comfortably when volatility refuses to compress. Misaligned timelines can turn orderly markets disorderly without any new information entering the system. As these pressures accumulated, the sense of a turning point became less about price direction and more about structural resilience. The market was being asked to absorb uncertainty across multiple dimensions simultaneously, and its response so far had been measured but strained. In past episodes, this is where markets either find a release valve or discover that one doesn't exist. The difference often hinges on a single development that reorders priorities overnight, and that leaves one unresolved question: which signal will force the reordering and whether silver is already positioned to magnify its impact. At the institutional level, the final phase before a shift often reveals itself through behavior that looks ordinary until it's viewed in retrospect, and today fit that T-pattern uncomfortably well. Participation remained steady, systems functioned, and nothing broke, yet the effort required to maintain that normality appeared to be increasing. Price discovery itself felt strained. Small trades moved levels more than expected at certain moments, then stalled without follow-through. That uneven response suggests a market still functioning, but with fewer participants willing to challenge emerging levels, a subtle sign of thinning conviction. Internal risk limits became the quiet governor. When markets drift into unfamiliar regimes, limits designed for historical conditions start to constrain behavior. Evidence suggested some desks were operating closer to those boundaries, not in distress, but with less flexibility to respond dynamically. Information flow remained asymmetric. Public narratives lagged behind observable behavior, leaving participants to rely on indirect signals. That lag creates opportunity for some and discomfort for others, and discomfort often leads to defensive positioning that can reinforce trends unintentionally. What defined this moment wasn't excitement or fear, but hesitation. The market seemed aware that something had changed, yet unsure how far that change would carry. Hesitation can stabilize markets briefly, but it can also store energy when resolution is delayed. The longer silver holds in this altered state, the more participants will be forced to act based on constraints rather than preference. When that transition happens, moves tend to be sharper and less forgiving, not because of emotion, but because options narrow. By the close, the sense of a turning point rested on fragility rather than momentum. The structures holding the market together were still intact, but under more strain than before, and strain has a way of revealing priorities quickly. What happens next will depend less on silver itself and more on which external signal arrives first, and whether the market can adapt without forcing a decisive break. For decades, silver's most consequential moments have rarely announced themselves at the peak of excitement, and this appears to be another one of those intervals where significance is only visible in hindsight. Today's price action didn't demand attention through spectacle, but through persistence, testing assumptions that have governed participation quietly and for a long time. What stands out now is not a forecast, but a condition. The market is operating with narrower margins for error, reduced tolerance for imbalance, and a growing reliance on signals that sit outside conventional analysis. Those conditions don't dictate direction, but they do amplify whatever force arrives next. If pressure eases, this episode may be remembered as a brief recalibration, a moment when risk was repriced and stability restored. But if constraints tighten further, the same behaviors observed today could become the foundation for a more durable shift. One that unfolds not through acceleration, but through sustained refusal to revert. The turning point then isn't defined by where silver trades tomorrow, but by whether the mechanisms that once kept it contained still function as expected. Markets can absorb change gradually, or they can be forced to adapt suddenly when familiar tools lose effectiveness. Silver is now sitting at that boundary where outcomes are shaped less by intent than by structure, and when structure begins to matter more than sentiment, the consequences tend to extend well beyond a single trading day. https://www.youtube.com/watch/FJFK9ZTVT0